Welcome to Earnings Recap. Today we're covering Ryanair's FY25 earnings report and call.
And quite a year for them.
Yeah, get this. Ryanair just became the first EU airline to carry over 200 million passengers in a single year.
Really remarkable milestone.
So today we're doing our deep dive into this latest report and the earnings call. We'll break down Ryanair's financial performance, what their future outlook looks like. Basically, all the key takeaways without the jargon.
Sounds good. Let's jump in.
Okay, so let's unpack this record-breaking year. That 200 million passenger number is impressive.
It really is. But it's interesting when you look at the profit, right? Profit after tax. It actually went down. Came in at 1.61 billion compared to 1.92 billion the year before.
So a noticeable drop. What drove that?
Well, the main factor seems to be about a 7% decline in their average airfares.
Okay, so lower ticket prices.
Exactly. But, it looks like that might have been a strategic move.
How so?
Because even with lower fares, their traffic, the number of passengers, it grew by 9%. That's how they hit that record, 200.2 million.
Right, so maybe they stimulated demand with those lower prices, sacrificed a bit of margin per ticket to get way more people flying.
Seems like it. And what's really interesting is the other side of the revenue coin. Ancillary revenues.
The extras, bags, seats, that kind of thing?
Yeah, exactly. That saw a solid 10% increase.
Yeah.
Even the amount per passenger ticked up by 1%.
Okay, so they're making up some ground there. And costs, that's always Ryanair's big story.
Absolutely. And this is maybe the most crucial point. Their unit cost per passenger stayed flat, completely flat year over year.
Wow. So even with inflation and everything else, they held the line on costs per person flown.
They did.
Yeah.
And when you think about it, that just widens their cost advantage over, well, pretty much all their EU competitors.
Yeah, that gap must be significant now. It gives them so much flexibility.
Huge flexibility. It means they can compete hard on price when they need to, like maybe they did this past year, or absorb cost pressures better than others.
Okay, so operationally they're running a tight ship. What about the fleet?
They ended the year with 618 aircraft, and importantly, 181 of those are the new game changers, the Boeing 737-8200s.
Those are the more fuel-efficient ones, right?
That's right, key to keeping those costs down. And they're still expanding the network, planning over 160 new routes for this summer.
Busy summer ahead, then. Any shareholder return activity?
Yep. They bought back and canceled about 7% of their shares during the year.
Okay.
And they're proposing a final dividend of $2.27 per share, likely paid out in September.
So, yeah, despite that headline profit drop, the underlying business seems pretty strong. Record passengers, cost control, new planes, returning cash.
It does look solid. But, FY25 wasn't without its challenges. We need to talk about those, too.
All right. What were the main headwinds they mentioned?
Well, number one was probably the Boeing delivery delays. They still got a lot of game changers, 181 by April, but fewer than planned.
And that limited how much they could grow traffic even more.
Exactly. It put a cap on potential growth. Then there was the timing of Easter.
The holiday shift. How did that play out?
Last year, Easter was split across their Q4 and Q1. This year, it fell entirely in Q1 of FY25, which made the Q1 comparison look weaker initially.
Got it. And the economy.
Yeah, they definitely pointed to pressure on consumer spending in the first half of their fiscal year. Higher interest rates, inflation, people watching their wallets.
Makes sense. Was there anything else impacting fares specifically?
There was. They mentioned a drop-off in bookings from some online travel agents, OTAs, just before the summer 2024 season kicked off.
So they lost a distribution channel unexpectedly.
Sort of, yeah. And it meant they had to stimulate demand with lower prices to fill those seats last minute.
Okay, so a combination of factors led to that fare drop and the profit dip. What about looking forward now into FY26?
Well, those Boeing delays are still casting a bit of a shadow. They're only expecting about 29 more aircraft this coming winter for the summer 2026 season.
So growth will still be somewhat constrained then?
Looks like it. They're projecting traffic growth of only around 3% for FY26. That takes them to about 206 million passengers.
Only 3%. That's quite a slowdown for Ryanair.
It is. They're aiming to get back on track towards 215 million in FY27, assuming the deliveries pick up pace.
And what about the cost side for FY26? Are they expecting that flat unit cost performance to continue?
Not quite. They're actually guiding for a modest increase, maybe 1-2% in unit costs next year.
Okay, what's driving that upward pressure?
A few things. Higher route charges, higher air traffic control fees. Those are ongoing issues. Plus, increased environmental costs.
Like what?
Things like the unwinding of the free emissions allowances under the EU ETS system, meaning they have to buy more carbon permits, and also the mandates for sustainable aviation fuel, SAF, which is still significantly more expensive.
Right, those green costs are starting to bite. But only 1-2% increase despite all that. How are they managing to keep it so low?
Well, they're counting on a few offsets. More game-changer deliveries. Those planes are just much more efficient.
Yeah.
Their fuel hedging strategy is also helping. They've locked in a lot of their fuel needs at decent prices. And just their general relentless focus on cost control across the board.
Okay, so costs slightly up. What about fares and demand for the year ahead?
The picture looks pretty positive, actually. They're seeing strong demand for summer 2025 travel.
The good news.
Yeah, and peak fares for the summer are apparently trending modestly ahead of last year.
Okay.
And for Q1, the current quarter we're in, they expect fares to be up quite significantly. Think mid to high teens percentage-wise.
Wow, that's a big jump. Why so strong?
Partly because Easter fell fully in this quarter, providing a boost. And also because the comparison period last year, Q1 of FY25, was relatively weak on the fare front.
Right, easy comps, as they say. What about Q2, the main summer quarter?
They think Q2 pricing will recover some of the ground lost last year. Remember that 7% decline? But they cautioned it might not recover all of it.
And beyond the summer, into the second half of their year.
That's where it gets hazy. They said they have very little visibility on H2 pricing right now.
So no full-year profit guidance yet?
No, not yet.
Yeah.
But their, let's say, cautious expectation is that they should recover most of last year's fare decline over the full year.
Okay.
And if that happens, they think it should lead to, quote, reasonable net profit growth for FY26.
Reasonable growth. So a recovery, but maybe not spectacular. Did they flag any major risks to that outlook?
Oh, yeah, the usual suspects for airlines. Potential tariff wars impacting trade and travel, macroeconomic shocks hitting consumer confidence.
Sure.
The ongoing conflicts in Ukraine and the Middle East obviously create uncertainty. And the ever-present problem of European air traffic control disruptions and strikes.
Always a factor in Europe. Okay, let's switch gears a bit. How's our balance sheet looking? Financial health.
Very strong. As of the end of March, they had almost $4 billion in gross cash.
Wow.
And a net cash position of $1.3 billion, which is actually quite healthy for an airline.
And you mentioned the Boeing delays actually helped the cash position.
Kind of, yeah. Because some of the planned capital expenditure, the payments for those new planes, got pushed out due to the delays. So less cash went out the door than expected in FY25.
I see. Any other moves on the financing side?
They increased their revolving credit facility, basically a big overdraft they can dip into if needed, up to $1.1 billion, and extended the term out to 2030. So more flexibility there.
Okay. And they have some debt maturing soon?
They do. Almost $2.1 billion in bonds coming due over the next year or so. $850 million this September, and then $1.2 billion in May 2026.
Big numbers. How are they planning to handle that?
This is pretty impressive. They plan to repay all of it using their internal cash reserves.
No new debt, just paying it off from cash.
Exactly. Their goal is to be almost entirely debt-free by next year.
Becoming nearly debt-free while running such a massive operation is quite something. What about shareholder returns, then, with these big repayments looming?
They did announce a new share buyback program for $750 million. But they signaled that the pace might be a bit slower over the next 6-12 months, precisely because they're prioritizing using cash for those bond repayments.
Makes sense. Pay down debt first.
Yeah, they reiterated their long-term commitment to returning excess cash, but acknowledged there might just be less excess cash in the very near term due to the debt payoff and also funding the future MAX 10 deliveries.
Right, those MAX 10s, they're the next big fleet development, aren't they?
They are. That's the larger version of the MAX. They're expecting the first 15 to arrive in spring 2027.
2027, okay. Still a ways off.
Yeah. But they have 300 of them on order, with deliveries running all the way out to March 2034. These are absolutely key to their really long-term target.
Which is?
Reaching 300 million passengers per year by fiscal year 34.
300 million. Yeah. Ambitious. Do they see the market conditions supporting that kind of growth?
They seem to think so. Their view is that short-haul capacity in Europe is likely to remain constrained for a while.
Why is that?
A few reasons. Ongoing engine issues impacting some Airbus fleets across the industry. The general OEM delivery delays from both Boeing and Airbus. And just continued airline consolidation in Europe. You know, weaker players getting bought or going under.
So less overall seat growth from competitors.
Potentially, yeah. And RYANAIR, with its cost advantage and delivery pipeline, feels well positioned to capture a good chunk of the demand that's out there.
Makes sense. You mentioned environmental costs earlier. Are they making progress on their own ESG metrics?
They highlighted some strong ratings, yeah. An A from MSCI, A- from CDP, and Sustainalytics ranked them #1 among airlines.
Pretty good credentials.
And they noted they're the first major airline to get their environmental targets validated by the Science Based Targets Initiative, the SBTI. So they're leaning into that efficiency angle, which, also helps their costs with things like the game changers and adding winglets to older planes.
Okay, beyond the numbers and the fleet, what else stood out from the report or the call? Any strategic shifts or interesting commentary?
A few things. One was removing the ownership restrictions. Non-EU investors can now buy RYANAIR shares.
Does that change much?
Well, the voting rights for non-EU holders are still restricted, but it did lead to them being included in the big MSCI World Index at the end of May. That increases their visibility to global funds.
I see. Any management changes?
A notable departure. Howard Millar, a very long-serving board member, is stepping down. He was pretty instrumental in their growth story.
Okay. What about Boeing? How's that relationship now? It's been tense at times.
Management sounded perhaps cautiously optimistic. More positive, anyway. They expressed more confidence in the MAX 10 certification process moving forward.
That's crucial for those future deliveries. Do they have anything to say about regulators?
Oh, yes. They renewed their calls for EU action on ATC reform, specifically protecting flights that just fly over a country during national strikes.
A long-running battle for them.
Indeed. And they also pushed back against national interference in pricing, like the Spanish government's rules on cabin bag fees.
But are they hopeful the EU will actually do anything?
Honestly, the tone sounded a bit skeptical. Even with things like the recent Draghi report talking about boosting competitiveness, there wasn't a strong sense of optimism that meaningful regulatory change on ATC or pricing is imminent.
Okay. Any other external factors discussed? Oil prices, maybe?
Yeah, they touched on the potential for oil prices to maybe ease off a bit, citing OPEC plus decisions and U.S. policy. But they stress their hedging protects them somewhat anyway.
Right. Their hedging program is pretty extensive.
It is. They also made it clear they're being very strategic about where they put their limited new capacity. Focus is on airports and regions that are cutting taxes or offering growth incentives.
So rewarding cooperative partners.
Essentially, yes. No plans for brand new bases right now, just adding routes and frequencies within the existing network.
And the big picture view on the industry? Still consolidation?
Absolutely. They reiterated their long-term view that the European market consolidates down to maybe 4 major airline groups eventually.
Interesting. Anything on specific travel trends, like transatlantic?
Just a brief mention, some anecdotal signs of maybe slight weakness in travel from Europe to the U.S., but that could potentially benefit European destinations if people stay closer to home.
Got it. What about labor relations? Always key for airlines.
They highlighted their multi-year pay deals are in place with most union groups, providing stability.
Good. And they explain the rationale behind paying off the bonds with cash.
Yeah, basically saying their own cash is the cheapest form of finance available right now, cheaper than raising new debt. And upsizing the credit facility was just for extra flexibility, a safety net.
Okay. Did they give more detail on cost inflation beyond fuel?
Yeah, they specifically called out route charges, ATC fees, and those environmental costs we discussed as the main pressure points outside of fuel and labor.
And the competitive landscape. Are others getting aggressive on pricing?
They said not really. Because overall capacity growth is still pretty limited across the industry, they aren't seeing what they'd call irrational pricing behavior from competitors.
Okay, a relatively stable competitive environment for now. What about customer-facing stuff? Any updates there?
They mentioned their new RYANAIR Prime membership program is having some early success, particularly with exclusive seat sales for members.
Trying to build more direct engagement.
It seems like it. And behind the scenes, their RYANAIR Labs tech division is busy. They mentioned a new integrated system for operations, crewing, scheduling, codenamed Rocket.
Streamlining the back office.
Exactly. Plus, ongoing work on the website, mobile boarding passes, and using more AI and machine learning for dynamic pricing.
Always looking for those efficiency gains. Did Ukraine come up?
Briefly, they reiterated interest in potentially re-entering the market quickly after the conflict ends, but stressed it depends heavily on airport readiness and, crucially, pricing.
Understood. What about RYANAIR Holidays? Is that a growth focus?
Not really, not right now. They said while the core airline traffic growth is strong, expanding the holiday package business isn't a major priority.
Okay. And finally, capital expenditures. What are they expecting to spend?
They gave some guidance. Around $2 billion for FY26, maybe higher, likely under $2 billion in FY27, then ramping up again in FY28 to maybe 2.503 billion as MAX 10 deliveries start.
Big investments coming.
Yeah, and interestingly, they flagged that setting up their own engine maintenance and overhaul shops will be a significant CapEx item spread over the next 3-4 years too, bringing more maintenance in-house.
Okay, quite a lot going on. So if we were to sum it all up.
Well, Ryanair navigated a tricky year with lower average fares, but they did it by flying a record number of passengers, showing just how strong that low-cost model is.
Right, and they kept costs flat, which is remarkable, maintained a really solid financial position, and they're clearly setting the stage for future growth, even with those Boeing delays being a constraint.
Exactly. So the focus now seems to be squarely on getting profitability back up, managing those non-fuel cost pressures, and executing that long-term fleet plan with the MAX aircraft.
Okay, makes sense.
And maybe the final thought for you, our listener, to chew on. When you look at Ryanair's massive, it's actually growing, cost advantage, and you combine that with the way the European airline market keeps consolidating, what does that really mean for the future, for the price you'll pay for flights, and for the level of choice and competition across Europe in the long run? Something to think about.